Hi, good evening, everyone. Thanks so much for joining the SGX Academy live webinar tonight. Tonight, we are going to be discussing the topic investing in SPACs on the Singapore Exchange. So since the start of this year, we have seen a number of SPACs being listed on the SGX. What we hope to be able to share with you tonight would be some of the basics around investing in SPACs so that you can decide whether this is something that you want to be putting into your portfolio. Before we start, just a brief introduction about myself. My name is Gerald. I'm the founder and CEO of Beansprout, and we are Singapore's next generation investment advisory platform. I spent the last 13 years in an investment advisory role in a global investment bank. And what we really want to be doing with Beansprout is to empower you to make better investment decisions by providing you with the insights. If you found today's session useful, please follow us on Facebook, Instagram, Telegram, or on our website, really whatever you prefer. We have a lot of interesting content that can also be found through these different channels. And lastly, some disclaimers before we start. Tonight's session is for the purpose of investor education only. Nothing of what is shared should be seen to be financial advice. Okay, so what will we be covering today? We will go through an introduction about what SPACs are, because you're probably wondering why should I actually be caring about SPACs. Thereafter, we will go through what to look out for when investing in SPACs. One of the interesting features about SPAC investing is that because of the different features, there are different investment strategies that come out. So we'll discuss those in more detail. And lastly, we will share some useful pointers when investing in SPACs before we go into the Q&A session. Okay, so the first question is, what is a SPAC? Very briefly, a SPAC is effectively a blank check company formed for the sole purpose of acquiring another company. So how does this really work? What happens at the start is that a group of financial managers would come together to form a SPAC. We'll call these financial managers the sponsors of the SPAC. What they do is to raise money through an initial public offering. Effectively, investors like you and I can decide to invest in this SPAC through the IPO. Thereafter, the proceeds from the IPO are put into a third-party account. We call this third-party account also an escrow account. Thereafter, the sponsors will go about starting to look for a target company to acquire. This may actually take some time. If an acquisition is made, what happens is that the SPAC and the target company combine to form a new publicly traded company. However, if an acquisition is not made, then what happens is that the SPAC is dissolved and investors get their money back. So in summary, this is the process around how a SPAC actually works. I'll go through in more detail later some of the intricacies about each part of the whole process. Okay, the next question you probably have would be, how would then SPACs be different from traditional IPOs? So you and I, we may actually be familiar with how traditional IPOs work, and we must be thinking, why must there be an alternative to the traditional IPO process? Some would perceive that SPACs act as a better alternative because it offers a more simple IPO process. So what this means is that the target company need not go through a very difficult process around the roadshows prior to the IPO. And this effectively makes the whole IPO process a lot more simple. Secondly, the specs offer you and I as investors certain protections. We'll go through in a bit more detail what some of these investor protections are. And last but not least, specs offer the target shareholders greater certainty on the valuation. So as we'll see in some IPOs, because of market volatility, there is a lot of uncertainty around the valuation where the company gets listed at. But through a SPAC, some of this uncertainty can be removed because it is decided through a negotiation process between the SPAC sponsor as well as the target company. So to bring it a bit more to life, we can share some of the companies which have been listed through SPACs. One name that everyone will be very familiar with would be Grab, which got listed through a combination with a SPAC listed in the US, Altimeter Growth Corp, late last year. In the electric vehicle space, we have got Lucid that also got listed through a SPAC. In fintech, we have got Sophie, and within the gaming space, it will be DraftKings that also got listed through a SPAC. So definitely familiar names that have chosen SPACs as a way for them to be going into the public markets. So what is very clear is that SPAC listings are becoming more common. If you were to look at the number of SPAC IPOs in the US, back in the previous peak, and this was in 2007, there were 66 SPAC IPOs in the US. But if you look at 2021, then that actually increased to 613, which is significantly higher than the previous peak. So it is very apparent that SPAC listings have become more common. The question would probably be, why have we seen more SPAC listings, especially over the past 1 or 2 years? In general, they are seen now to be more serious investment vehicles. We have got more well-known participants who are willing to be involved in SPACs. We have actually seen companies that are willing to get listed through the SPAC route. If you look at the average size of SPACs, that has increased as well. So if I was to look at the period from 2010 to 2012, the average SPAC size would be below 100 million US dollars. But by the time we got to 2020, then the average SPAC size was actually close to 400 million US. Another positive development would be that more SPACs have been able to acquire targets, because that is what we want as a SPAC investor. If you look at the 2010-2011 period, then what we see is that there are still quite a number of SPACs that get liquidated, or in other words, they get dissolved without being able to find a target. But by the time we got to 2019, 2020, what we see is that there is a greater proportion of SPACs that are able to complete the SPAC acquisition, or are actually not liquidated at the end of the period of time where they are required to be finding a target. So having gone through some of the introduction about SPACs, we'll go into a bit more detail about what happens at the de-SPAC stage. So de-SPAC is the phase of the entire SPAC where the SPAC acquires another company. So this is effectively the process. At the start, you would have investors, including the SPAC sponsor, which are effectively the managers of the SPAC and responsible for finding a target. If we have invested in the SPAC at the IPO, we'll be considered public investors. Once a target company is found, what happens is that potentially the target company shareholders would come in as part of the combination as well. We also have another group of investors who are called the PIPE investors, who are private placement investors. So what they do is that they provide the additional equity fundraising to be able to fund the business combination. So what happens is that by the time the business combination is completed, there are 4 different groups of shareholders, and this would include the SPAC sponsors, it include public investors like ourselves. We have the target company shareholders, and last but not least, the PIPE investors. So I mentioned earlier about investor protection. This is a very important characteristic of SPACs, and effectively what they do is to provide us as investors with some degree of protection. The 2 key investor protection mechanisms would be the redemption rights and the voting rights. So firstly, what is the redemption right? So regardless of whether you vote for or against the proposed business combination, you can always choose to redeem your shares for cash prior to completion of the business combination. So remember, when we have bought into the SPAC, our capital is actually locked up in this escrow or third-party account. What happens is that if at any point in time before the completion of the business combination, we want to be getting our capital back, then this is a redemption right that allows us the ability to do so. The second important investor protection mechanism is the voting right. So the completion of the business combination can only proceed if more than 50% of independent directors and more than 50% of shareholders vote in favor of the transaction. So you do have a say in whether you like the target company that the sponsors have decided to acquire. If you do not like it, you can actually vote against it. And if the acquisition goes through anyway because more than 50% of shareholders and directors have voted for it, you can choose to redeem your capital anytime before the completion of the business combination. So those are very important protection mechanisms for holders of SPACs. The other protection mechanisms to take note of is that in Singapore, there is a requirement for the sponsors to place at least 90% of the gross IPO proceeds in an escrow account. So what this means is that they cannot be using your capital for other reasons apart from those stipulated as part of the prospectus during the IPO, and they are bound by rules around what can be incurred against the IPO proceeds versus those that cannot be incurred as expenses. There is a time frame for the sponsors to be completing the business combination, so they can't take forever and be holding onto your capital while they continue to look for a target to be acquiring. So this table would summarize some of the key listing requirements in Singapore and compare that to the US. So for those who might already be familiar with how SPACs work in the US, there are important differences in terms of how the SPACs are regulated in Singapore, and generally they afford investors like you and me more protection. So we mentioned earlier about the time frame for completion of business combination. In Singapore, the time frame is 24 months. So they need to be able to find a target within 24 months. And if they are not able to do so, they can ask for a 12 months extension, but that is actually subject to certain conditions. The other important difference to note is really around this thing called a sponsors promote. So what sponsors promote would be the entitlement to shares given to the sponsors, typically on favorable terms, to be able to incentivize them to make a good acquisition. In Singapore, the limit on the sponsors promote is 20%, while in the US, there is no limit. So once again, that ensures that there is certain alignment of interest and offering you protection as an investor of the SPAC unit. Okay, so we have actually gone through some of the basics of SPACs. Before we go on further, we'll just do a little bit of a test, just to make sure that we understand what has been discussed over the past few slides. So the question is, which of the following are features that offer protection to investors of a SPAC? A, redemption right. B, voting right. C, money is kept in an escrow account. And D, all of the above. Okay, so the answer here is D, all of the above. So remember, there are different investor protection mechanisms for investors of SPACs, and this would include redemption rights, voting rights, and having your money being kept in an escrow account.